Welcome to this explainer. I'm absolutely thrilled to have you tuning in today. Look, if you're ready to dismantle that flashy, neon-lit fantasy of day trading and replace it with the cold, hard mechanics of real profitability, you are in exactly the right place. Today, we're taking a deep dive into the source material from some of the most insightful minds and, honestly, brutally honest critics in the trading space. We're going to strip away all the noise and look at exactly what separates the winners from everyone else. So let's just dive right into it.
All right, we're going to drop the hammer right out of the gate here. 90%. That is the brutal, unavoidable statistical reality of the markets. 90% of all retail traders lose their money. And we're not talking about just breaking even. They completely drain their accounts. It's a staggering number, and it really should immediately recalibrate how you view this entire industry. Trading isn't some get-rich-quick scheme. It's actually an incredibly hostile environment that's practically designed to transfer wealth from the uninformed right over to the prepared.
So why does the market always seem to know exactly where your stop loss is? I mean, seriously, have you ever felt that? You enter a trade, you safely tuck your stop below a key level, the market dips down, takes you out to the exact pip, and then immediately rockets off in your original direction. It feels super personal, doesn't it? But here's the secret. It isn't bad luck. It's not a curse. As we're going to see, it's a fundamentally flawed psychological and structural framework that puts you on the absolute wrong side of the market's true mechanics.
To get you on the right side, here is our survival roadmap for today. We'll be covering 1. The fake guru trap. 2. Why 90% fail. 3. Decoding smart money concepts. 4. Discipline over dopamine. And 5. The boring path to profit.
Okay, starting off with Section 1, the fake guru trap and the overall illusion of trading.
Let's be real, the trading education industry can be incredibly predatory. Sources like Iman Trading have done phenomenal work exposing massive influencers out there. We're talking big names like TJR Trades and ICT. And these gurus, they all share identical traits. They sell super expensive mentorships, they flex these rented supercars to hack your dopamine, and crucially, they completely refuse to show verified long-term broker track records. Oh, and when they lose, they just quietly delete those videos. They aren't actually in the business of trading. They are in the business of selling you a dream. If your education is based on chasing a lifestyle rather than actually learning a skill, you're already part of that 90% that fails.
The real damage these fake gurus do is that they teach you terrible analysis. As the expert GFX points out, bad analysis is hindsight-driven, it's highly emotional, and it's cluttered. It's basically throwing 10 random lines and lagging indicators onto a chart just to justify a bias you already hold. Good analysis is an entirely different beast. It's forward-looking, highly structured, and totally actionable. Now, that doesn't mean you're predicting the future. It just means you frame the most likely paths and have a strict, calm plan for what to do if the price gets there. Good analysis completely removes the guesswork.
Moving right along to Section 2, why 90% fail, focusing on the psychological pitfalls.
It's kind of tragic when you map out the chronological evolution of almost every retail trader. Day 1 begins with just pure euphoria and overconfidence. You make a little money on a random bet, and boom, you think you're genius. But by week 2, that first inevitable string of losses hits. And this is where the fatal flaw is triggered. Month 1 introduces action bias and revenge trading. The amateur thinks they need to trade more to win that money back, right? So they jump into every twitching candle. And by month 3, complete account liquidation. The desire for constant action is a guaranteed path to blowing your account.
Because, it really all boils down to this. 1 hour of highly focused work is infinitely greater than 10 hours of chaos. Just flicking through 10 currency pairs an hour, drawing lines everywhere, and firing off random trades, that isn't hard work. It is literally just a dopamine hit disguised as progress. The market does not pay you for the hours you sit there staring at a screen. It pays you for the quality and the discipline of your execution.
All right, Section 3, decoding smart money concepts and diving into market mechanics.
You probably hear the term smart money concepts, or SMC, thrown around a ton online. But true SMC, as taught by sources like Fractal Flow, isn't about wild conspiracy theories. It's about analyzing volume profiles, real institutional supply and demand, and liquidity. It's recognizing that the massive banks are the ones moving the market, and you simply need to trade alongside them. It's also about avoiding those nasty retail traps. For instance, the trader AR coined the term TBS, turtle body soup. It's basically a trap where retail traders are lured into fake breakouts only to get swallowed whole by institutional momentum. Your real edge comes from seeing exactly where the big money is stepping in.
When you look at insights from Pro Trading School, there's this really stark contrast between the two camps.
While retail amateurs are busy sweating and chasing fast breakouts, smart money is just patiently waiting for liquidity sweeps. While retail is relying on cluttered, lagging indicators, the institutions are looking at raw price action and volume profiles. And the mindset? Man, retail is totally driven by FOMO, the fear of missing out. Institutions? They are actively exploiting that retail FOMO and specifically targeting their stop losses. This is exactly why the market seems to know where your stop loss is, because the institutions are the ones putting it there.
Which brings us to Section 4, Discipline over Dopamine, your ultimate shield.
The source stick trader brings up this profoundly powerful concept from Japanese philosophy called Kaizen, which means continuous small improvements. Real discipline isn't about forcing yourself through sheer willpower. It's a cyclical process. Step 1, you learn the mechanics. Step 2, you apply the edge. But here is where almost everyone fails. Step 3, you absolutely must objectively observe your emotional reactions to your losses. When you get stopped out, do you panic? Do you get angry? Step 4 is adjusting that mindset and strengthening your discipline by just 1% every single day. You aren't just mastering the chart, guys, you are mastering yourself.
And this leads us right into the mechanical side of discipline. As JFX puts it so perfectly, position sizing is what keeps you in the game. The key isn't to avoid losses, it's to survive them. I literally cannot emphasize this enough. You can have a totally mediocre strategy, but with strict risk management, like risking exactly 1% per trade, you will survive. But if you have a world-class strategy and you randomly oversize your positions just because you have a good feeling today, the market will eventually destroy you. Small, consistent position sizing is your absolute armor against market chaos.
It all distills down to this incredibly powerful mindset from Jaden Trades, DOD, discipline over dopamine. Taking a bad impulsive trade just to feel the thrill of the market moving, that's dopamine. Following your rules, waiting for your perfect setup, and having the strength to walk away when there is nothing to trade, that is discipline. You have to actively choose discipline over that chemical rush in your brain every single time.
Finally, Section 5, the boring path to profit and the reality of being a professional.
You know, the legendary trader Jesse Livermore, who's heavily featured on Whispers of Livermore, he famously said, "The fewer decisions you make, the better you trade." Just let that sink in for a second. The hallmark of a true professional isn't a flurry of keystrokes and yelling at 6 different monitors. It's patience. It's the ability to sit on your hands and do absolutely nothing for the vast majority of the time, waiting patiently for the exact moment your edge presents itself.
This is exactly what the plateau of latent potential from Atomic Habits looks like when applied to trading. For those first 6 months, you're stuck in this flat survival phase. You're putting in boring, consistent inputs and seeing almost zero results. Naturally, most people just quit here. But in months 6 to 12, you start seeing slight compound growth. And if you actually stick to that boring discipline, year 1 and beyond is where the massive exponential reward finally kicks in. Those boring inputs simply take time to compound.
Ultimately, this builds the core identity of the 10% who actually make it, the professional reality. You have to embrace that most days require absolutely no action at all. You completely ignore your feelings and trust the cold math of your edge. When you lose, you don't throw a tantrum, you just accept it as a simple business expense. You completely detach your ego and your self-worth from the outcome of any single trade. And most importantly, you step back and let your probability play out over hundreds, if not thousands, of calm, systematic executions. It's a business, not a casino.
So I want to leave you with a really provocative thought to chew on before you ever open up a chart again. Ask yourself, are you trading to actually make money, building a highly structured business based on patience and risk management, or are you just paying the market for an expensive dopamine hit? The choice between the illusion and the reality is completely up to you. Thanks so much for joining me on this explainer. Keep learning, stay disciplined, and I'll see you next time.